Good evening and welcome back to AP Macroeconomics Live Lesson. I'm Jen Rayfields from Basking Ridge, New Jersey, and tonight we are going to be reviewing Unit 4, spending time examining those Unit 4 free response questions. So tonight our goal is to cover the topics that are included in Unit 4. We're going to be spending most of our time on those topics that I know traditionally give students a little bit more trouble, but we want to make sure that we carefully review the money market model, monetary policy, and the loanable funds market model as well. So we have several free response questions lined up for tonight that we're going to be spending time going through, emphasizing the bank balance sheet questions to help you understand how multiple deposit expansion of the money supply works and how to solve problems that ask you about changes in the banking system that result from changes in changes in banking and also changes in monetary policy. So our essential questions for Unit 4, what is money, that we've already spent some time on. How is the price of money determined? Well, you know by now that the price of money is the interest rate. So the price of anything is determined by the supply and demand for it. So we'll take a look at two interest rates, the nominal interest rate in the money market and the real interest rate in the loanable funds market. Again, we're going to spend a lot of time on multiple deposit expansion and the role of banks in expanding the money supply. And then we'll talk about monetary policy. So the enduring understandings that are associated with these essential questions include, how important money is in terms of its three functions, comparing the value of goods and services. Interest rates provide a measure of the price of money, and we're going to connect borrowing and saving in the loanable funds market. We'll talk about the importance of banks. Of course, in the money market, we're going to look at the demand for and supply of money in terms of the nominal interest rate, and we're going to connect that to monetary policy and the role of the Fed in setting the money supply. We're going to review the role of fiscal and monetary policy and how they affect the macroeconomy. And then we'll finish up again with the loanable funds market and an examination of the real interest rate. And we'll also just spend a few minutes reviewing nominal and real interest rates and the relationship between the two. So that's where we're headed. It's packed. It's a lot, but I really hope that the reviews of these topics and the reviews of the free response questions will help increase your confidence level with Unit 4 questions. All right, so you'll remember that when we talked a few days ago about Unit 4, we spent some time talking about how to measure the money supply and how to understand the money multiplier. So this graphic organizer I developed based on similar ones that I've seen really call your attention to the fact that bank reserves are not part of the money supply. They're part of the monetary base. And this is the mechanism of monetary policy, right? Especially the tools that we talk about in AP Macro. The Fed controls the monetary base through its control of bank reserves and then through its influence on bank reserves. And then bank reserves support the money supply. And then the money multiplier is the ratio of the money supply to the monetary base. More often than not, we're talking about the M1 measure of the money supply, but we could be talking about M2 as well. So the money multiplier is equal to 1 divided by the reserve requirement ratio. This is a formula you definitely want to know. And the reserve requirement ratio is established by the Federal Reserve in the United States or the central bank in other countries. So this would be an example of how to conceptualize the relationship between the monetary base and the money supply. So we have a question: assume the reserve requirement is 10% and Elizabeth deposits $1,000 in the bank. If you watched the topics 4.1 to 4.4 video, you know I did this problem with Audrey depositing money in the bank. Audrey is my younger daughter. Elizabeth is my older daughter. So today it's Lizzie's turn. Lizzie gets $1,000. She puts it in the bank. And then we talked about how does that deposit get recorded on a T account for a single bank. And we know the deposit goes in as a liability. And then based on the reserve requirement, the bank now has an additional $100 in required reserves and an additional $900 in excess reserves. So very often multiple deposit expansion, the money supply questions ask you, how does a transaction like this ultimately affect these three elements of the banking in the entire banking system. So when we want to look at the banking system as a whole, we're going to talk again about assets and liabilities, and we're going to apply the multiplier to it. So again, the multiplier is found by dividing 1 by the reserve requirement ratio. When the reserve requirement is 10%, the multiplier is 10. So basically, the way you calculate the maximum change in the banking system is by applying the money multiplier to whatever initial change you're looking at. So the max change in excess reserves would be the initial change in excess reserves times the multiplier. The max change in deposits would be the initial change in deposits times the money times the multiplier, and the same thing for required reserves. So the rule of thumb really is that the maximum change in anything is equal to the initial change in that thing times the money multiplier. And then the trick becomes, what are you being asked for? There are questions that ask, what's the maximum change in loans? What's the maximum change in total reserves? And what's the maximum change in the money supply? So here's a formula for all seasons. The max change in the money supply is equal to the initial change in excess reserves times the multiplier plus the initial change in the money supply. And that's where you have to be careful and recognize whether or not the transaction results in an initial change in the money supply or not. And this particular example, when Elizabeth takes $1,000 in cash and deposits it into a demand deposit account, the money supply is not changing with that initial transaction. So the maximum change in the money supply that could be generated by this transaction would be equal to the initial change in excess reserves times the multiplier. I'm going to really try to help you flesh this out in the balance sheet questions that I've pulled for the free response section. Okay, so there are 2 key graphs in this unit. We start with the money market model. And the money market model is a supply and demand graph that describes the relationship between the price and quantity of money. And here we go for short-term borrowing and lending. So short-term borrowing and lending means those decisions that people make about borrowing money that are not sensitive to inflation. It's really short term in a society with, in an economy with stable prices. These decisions are not impacted by the rate of inflation because the borrowing isn't going on for long enough for the inflation rate to matter. So the nominal interest rate is the stated interest rate, and that's the interest rate we're going to be using in our money market model. So the price of money in the short term is the nominal interest rate, so that goes on the vertical axis. And since it's a supply and demand graph, we have price on the vertical axis and quantity on the horizontal axis. So of particular note, in terms of nominal interest rates, is a short-term interest rate called the federal funds rate, which I'm sure you know is the overnight interbank borrowing rate. This is the rate that member banks charge one another for overnight borrowing. The interest rate it's also the interest rate targeted by the Fed when it conducts monetary policy. The Fed does not set the federal funds rate. The Fed sets the discount rate. The discount rate is the short-term borrowing rate that the Fed charges member banks to borrow directly from the Fed itself through what's called the discount window. So make sure you can distinguish between the discount rate and the federal funds rate. The federal funds rate is something you might want to think about as being over here on this vertical axis, because that's what the Fed is targeting when it changes the amount of reserves in the banking system in order to influence the money supply. So here's what the graph looks like. We have a vertical money supply curve, a downward sloping money demand curve, and some equilibrium nominal interest rate where money supply equals money demand. So the money supply, again, is a function of the monetary base, which is determined by the nation's central bank. And so we depict it as independent of the nominal interest rate because the quantity of money is going to be a function of what the Fed sets the quantity of money to be, and it's not a function of what the interest rate is. So the Fed has control again over the amount of reserves in the banking system, which is a part of the monetary base. Okay, so this is how monetary policy works. All of the 3 tools of monetary policy that you learn about in this course, and many of the ones that you haven't, are the tools that the Fed uses to change the amount of reserves in the banking system. So if we have an increase in reserves through multiple deposit expansion of the money supply, when those excess reserves get lent out money is created. So an increase in reserves leads to an increase in the money supply, which drives down nominal interest rates. That affects the macroeconomy because the things we buy with borrowed money, interest rate sensitive components of consumption and investment spending, are going to increase, which leads to an increase in aggregate demand. So these are the three tools that you learned about that would lead to an increase in reserves. The Fed could lower the reserve requirement, it could lower the discount rate, or it could buy bonds. Open market operations is what the Fed primarily uses in order to influence the money supply. So if the money supply increases, we see that at the initial interest rate, right? There's the quantity supplied is greater than the quantity demanded. We know that that is a surplus, and a surplus is eliminated through falling prices. So the increase in the money supply creates a surplus at the initial interest rate, which leads to a decrease in the price of money, and we end up at a new equilibrium nominal interest rate here. Okay, so that's how we use the money market model. Now, the money demand curve shows this inverse relationship between the price of money and the quantity of money demanded. The demand for money in this model represents the desire to use money to buy goods and services, or the transactions demand for money. In an intermediate macro course, you might learn about other types of demand for money, but we talk predominantly about transactions demand for money in this course, and we're talking about the money people want to hold as cash as opposed to as a less liquid financial asset that earns interest. So the higher the nominal interest rate, the higher the opportunity cost of holding money in the form of cash, and so the lower the quantity demanded of money. That's what the money demand curve represents. The determinants of money demand that you really want to be familiar with are changes in income, changes in the price level, changes in expectations, and changes in preferences. All else equal, an increase in an increase in real income, or an increase in real GDP, which should be understood as an increase in real income, leads to an increase in the amount of goods and services people want to buy, which leads to an increase in the transactions demand for money. Similarly, when the price level rises, in order to continue purchasing a given amount of goods and services, a greater quantity of money is required, and that would lead to an increase in the money demand, in the demand for money as well. So this is what it looks like. You shift the money demand curve to the right, and at the initial equilibrium interest rate, we have a shortage that's created. The shortage is eliminated through rising prices, and we end up at a new higher nominal interest rate as a result of the increase in money demand. So how does this show up on the AP exam, right? So these are some of, I culled through the released FRQs to see all of the different ways that you can be assessed as to your understanding of the shift factors of the money demand curve. So one reads, a drop in credit card fees causes people to use credit cards more often for transactions and demand less money. So that would cause a decrease in money demand, which we show in the model by shifting the curve to the left. The second one I found said, assume that customers wish to hold less money because they use credit cards more frequently to purchase goods and services than cash. Again, that would lead to a decrease in money demand because we're not paying for goods and services with cash anymore. We're paying for it with borrowed money, which is what credit card means. And then show how an increase in the income level will affect the nominal interest rate in the short run. Well, that would cause an increase in money demand because we need more money to purchase the same amount of, we have more money and we buy more goods and services with them. So we would show an increase in aggregate and money demand, which drives up the nominal interest rate. So this just gives you an idea of what it might look like to see a question on the AP exam that asks you about the money market in a way that would ask you to understand what the money demand curve represents and what causes it to change. So the determinants of the money supply curve in this course is the Fed, right? If the Fed conducts monetary policy, that's going to lead to a change in the money supply. On the money demand curve, you might see a question that includes this kind of language. And I think this year in particular, when we're not going to be demonstrating our understandings with graphs, it is even more important for you to be able to explain how monetary policy would influence the interest rate. You could use the graph as a tool, but I think you want to be able to explain it in words now and then connect what happens in the money market as a result of monetary policy to the real economy. And we're going to do that as we get to the end of this. So the second key graph in this unit is the loanable funds market. So whereas the money market is like a real market with buyers and sellers, the loanable funds market is a hypothetical market that imagines all of the different people who have money that they don't want to spend now and they want to save, and it brings them together with people who don't have as much money as they want for borrowing. So the loanable funds model, there's all different kinds of ways of saving money, and there's all different kinds of ways of borrowing money. So the loanable funds market is hypothetical, but it's useful for understanding the influence of the demand for and the supply of borrowed money in terms of the real interest rate. So the loanable funds market is examining the relationship between the price and quantity of money for long-term borrowing and lending. And that means the time period during which inflation will have an influence on the real interest rate, either the real interest rate paid by borrowers or the real interest rate earned by savers. So the price of money in the long term is the nominal interest rate given some expected rate of inflation, which would tell us what the real interest rate is. So that's why we graph the real interest rate on the vertical axis and the quantity of loanable funds on the horizontal axis. Again, it's a supply and demand graph, price on the vertical axis, quantity on the horizontal axis. But in this case, the real interest rate is the price of long-term borrowed money. All right, so the supply of loanable funds represents the behavior of savers. And we see that as the real interest rate rises, the quantity of loanable funds supplied increases. That's a positive relationship. And you want to equate the behavior of savers with people who wish to buy bonds in order to generate income for themselves that you get when you are a bondholder and receive interest payments. So the supply of loanable funds is analogous to the demand for bonds. Now, the demand for loanable funds represents the behavior of borrowers. These are the issuers of bonds. These are the people who are borrowing money. And so there's an inverse relationship between the price of borrowed money and the quantity of borrowed money demanded. So the demand for loanable funds curve is downward sloping. And again, just as you would equate the supply of loanable funds to the demand for bonds, you want to equate the demand for loanable funds to the supply of bonds. Firms and governments issue bonds to raise financial capital, okay, so that they can buy goods and services, so that they can invest and spend, purchase capital goods in order to bring new goods and services to market, to sell them, to generate profits. So the higher the interest rate, the lower the expected rate of return is on investment spending. And so that contributes to the inverse relationship that we see in a downward sloping demand for loanable funds curve. So the quantity of the real interest rate is found where the quantity of loanable funds demanded is equal to the quantity of loanable funds supplied. And here's how this shows up in the free response question. So here are examples of all of the types of things you might see that are assessing whether or not you recognize what causes a change in the supply of loanable funds. So assume there's an increase in the country's national savings. Assume the government reduces the tax rate on household interest earnings. Assume the tax rate on interest income from household savings is lowered. Assume the government implements special tax incentive to encourage individuals to increase savings for retirement. So do you see how all of these work? The idea is all of these things are designed to incentivize savings. And so an increase in savings is shown as an increase in the supply of loanable funds, which leads to a decrease in the real interest rate. Now, what about the demand for loanable funds? So here are some examples. Assume that this is predominantly going to assess whether you understand the effect of government deficit spending on real interest rates, so that you can then connect it to crowding out, changes in investment spending, and changes in long-run economic growth. So here's the beginning of it, right? Assume the country's government increases deficit spending. Show the effect of an increase in government borrowing from the public on the real interest rate. Show the effect of an increase in a country's budget deficit on the real interest rate. Now, assume that businesses are granted a tax credit on spending for machinery. You should recognize that machinery is a capital good and that firms would buy machinery in order to produce more goods and services. And so if they get a tax credit for investment spending, they're going to do more investment spending. And so the demand for loanable funds is going to increase. So again, primarily, demand for loanable funds shifters relate to government borrowing, but it might also influence. You might be asked a question that asks how a change that affects firms would affect the demand for loanable funds curve as well. All right, so we would show an increase in the demand for loanable funds by shifting the curve to the right. That leads to an increase in the real interest rate. Okay, so one other topic in this course, in this unit, is the relationship between nominal and real interest rates. And I know this can be a real tricky point. It's sort of simple conceptually, but it becomes tricky in its application. So let's see if we can tease out some nuances here that might be helpful to you. So we know that the nominal interest rate that somebody is willing to pay is based on the expected real interest rate they want to pay and their expectations for what happens to inflation. So if you go into a bank as a borrower and they tell you the interest rate is the nominal interest rate is 8%, if you don't want to pay more than 5% real interest rate, that means you're expecting the inflation rate to be 3%. So when you're you're entering into a decision today, you don't know what the real interest rate is going to be. You only know what the nominal interest rate is because that's the rate that's published when you go in to borrow. So it's based on your expectations of inflation and the real interest rate you're willing to pay. And the same thing for banks, right? They want to generate a real interest rate in terms of the money that they earn for lending. And so they are going to charge a nominal interest rate based on their expectations for inflation and the real return they're looking for. So when you're making your decision today, you're doing it based on the nominal rate, which is a function of your expectations. Now, after the fact, we can look and see what the real interest rate was by comparing the nominal interest rate with the actual inflation rate. So at the end of a period of time, we can say, okay, what was the real interest rate paid on this loan? Well, we know what the nominal interest rate was. We know what the actual inflation rate was. That allows us to determine what the real interest rate was. In the short run, before inflationary expectations have changed, nominal interest rates and real interest rates move together. So an increase in the money supply, which drives down nominal interest rates, in the short run will drive down real interest rates because there's no change in inflationary expectations. However, in the long run, once inflationary expectations have been factored into decision making, nominal interest rates adjust to achieve a desired real interest rate. And we will see how this is assessed in the AP FRQs, macro FRQs, when we start reviewing them. Okay, so in general, it is true that if you read the free response questions, you will be asked to apply monetary policy to the money market. You'll be asked about the effect of monetary policy on nominal interest rates by graphing it in the money market, and to apply fiscal policy to real interest rates via the loanable funds model. All right, in general, that's true. If you get a monetary policy question, you're probably going to be asked for a money market graph. If you're asked a fiscal policy question, you're probably going to see a loanable funds model. Okay, so now finally, in this course, one of the enduring understandings is that there are short run outcomes of fiscal and monetary policy. So let's see if we can sort of put this all together. So here is the ADAS model that's featured in Unit 3. And obviously we're looking at an economy in a recessionary gap because current output is less than potential output. We can also show a recessionary gap in the business cycle model. So what the potential output is represented by this constantly increasing output over time, and the actual output is a subject to the business cycle. So if actual output is less than potential output, we are in a recessionary gap. So I put a point here and labeled it RG. So that's another way to show a recessionary gap. You can also show it using a production possibilities model. So if the economy is operating at a point inside the nation's PPC, we know that they have unemployed resources. We know that actual output is less than potential output. So 3 different ways of showing a recessionary gap. And the goal of stabilization policy would be to close the recessionary gap. And if we have a recessionary gap, we're going to be looking at expansionary policy. So remember, we've talked about these as demand side policies. The fiscal and monetary policy that are featured in units 3 and 4 are demand side policies that are designed to influence aggregate demand. So you want to make sure you can explain how fiscal policy affects aggregate demand and how monetary policy affects aggregate demand. And then once you know what happens to aggregate demand, you can use your ADAS model to predict the effect of those policies on national income, on output, on the unemployment rate, and on the inflation rate. So remember that there's two fiscal policy. One form of fiscal policy is to increase government spending. That leads directly to an increase in aggregate demand. Because government spending is part of aggregate demand, the government can also increase transfers or decrease taxes. Both of those serve to increase disposable income for households. And when households have more money, they buy more goods and services. So the way that an increase in transfers or a decrease in taxes affects the economy is by affecting disposable income. And the more disposable income you have, the more consumption you're going to see. So be able to distinguish between the direct effect of a change in government spending on aggregate demand and the indirect effect of a change in taxes or transfers on aggregate demand via changes in consumption that result from the effect of a change in taxes or transfers on disposable income. Being able to connect those dots is going to be key. Now, the same thing is true for monetary policy. Monetary policy affects the macroeconomy indirectly via changes in the interest rate. So we know that the three tools of monetary policy, changing reserve requirements, changing the discount rate, and open market operations, are designed to change the amount of reserves in the banking system. So if we want expansionary monetary policy, we want to see an increase in reserves that will lead to an increase in the money supply, which will lead to a decrease in nominal interest rates. And that results in a decrease in the cost of interest rate sensitive goods and services. In other words, all of the things that we pay for with borrowed money, both households and firms, those things are relatively cheaper when the price of borrowed money goes down. And so consumption, interest rate sensitive components of consumption and investment spending are going to increase, and that's going to cause aggregate demand to increase. So make sure you can describe exactly how fiscal and monetary policy work in order to influence short-run macroeconomic outcomes. And that is the last topic for review, and we're going to get right into these free response questions now. So I started with the 2011 question 3. This is a balance sheet question. It says Sewell Bank has the simplified balance sheet to the right. So we have assets on one side, liabilities on the other. And so make sure that you understand there's required reserves, excess reserves. The bank has lent out $8,000. They, on the asset side, they have $7,000 worth of government securities, and they also have building and fixtures that are worth $3,000. So the first part of the question, part A, says, based on Sewell Bank's balance sheet, calculate the required reserve ratio. So since they have zero excess reserves, we know that the required reserves is 2,000 for demand deposits of 10,000. And the reserve requirement can be found by dividing the amount of required reserves by the amount of demand deposits. So in this case, that would be 2,000 divided by 10,000, or 0.2, or 20%. Okay. A lot of times you're given the reserve requirement and the demand deposits, and you have to figure out how much is the required reserves. This is asking you to do something a little different. All right, then part B reads, suppose that the Federal Reserve purchases $5,000 worth of bonds from Sewell Bank. What will be the change in the dollar value of each of the following immediately after the purchase? So we're looking to see what will be the initial change, right? That's what that term immediately after. Now we're looking for the initial change in excess reserves and initial change in demand deposits. So let's use our balance sheet as our T account as a tool to see what's going to happen. So we're going to start by saying, okay, well, the bank is selling $5,000 worth of securities. The Fed is purchasing them. So we're going to decrease government securities by $5,000, leaving $2,000 in that part of the T account. Now it's going to be replaced with, so the bonds come off the bank balance sheet as an asset and is being replaced with excess reserves. That's what, so the Fed has purchased those bonds and credited the bank with cash, with money. right? But in this case, we have to understand that that money goes onto the bank balance sheet as excess reserves. So government securities is going to go down by 5,000, excess reserves is going to go up by 5,000. So the initial change in the excess reserves is going to be that it's going to increase from $0 to $5,000. Now that's how you handle this transaction. And so what happens to demand deposits? Nothing. So the change in demand deposits is 0. We're not doing anything on the liability side of the balance sheet. We're only working on the asset side. And this is one of the trickiest parts about working with monetary policy, right? You have to recognize, is this transaction going to be handled on the asset side, or is this transaction beginning its life on the deposit side? And we'll look in these questions to see what the keywords are that will point you in that direction. So if it says they buy directly from the bank, they buy the securities directly from the bank, they're saying work on the asset side of the equation. They're even giving you the chart with the government securities already on the asset side to help you with this. All right, then we have to calculate the maximum amount that the money supply can change as a result of the $5,000 purchase of bonds by the Federal Reserve. Okay, so the max change in the money supply is equal to the initial change in excess reserves times the multiplier plus the initial change in the money supply. A shortcut for students is to find the maximum change in the money supply by multiplying it times the initial change in the money supply. But in this case, remember, bank reserves are not part of the money supply. There is no initial change in the money supply with this transaction. This transaction begins its life as excess reserves, which is not an initial change in the money supply. So $5,000 goes in as bank reserves, right? So there's no money created with that initial transaction. However, since the entire $5,000 can be lent out and subject to the multiplier, our initial change in excess reserves of 5,000, right, times the multiplier plus 0 is going to equal our max change in the money supply. So we could use our shortcut, but you really want to make sure you understand why it works. So in this case, the maximum change in the money supply is $25,000. All right, part D reads, when the Federal Reserve purchases bonds, what will happen to the price of bonds in the open market? And we're asked to explain this one. So we know that there's an inverse relationship between interest rates and bond prices. Expansionary monetary policy is designed to produce a decrease in the interest rate that is going to lead to an increase in the price of previously issued bonds. So why is that true? Because the decrease in the interest rates means that newly issued bonds are going to have a lower nominal interest rate than previously issued bonds. And so previously issued bonds are going to become relatively more valuable. They're more attractive to purchasers of bonds. And so the price of those bonds is going to rise. All right, part E reads, suppose that instead of the purchase of bonds by the Federal Reserve, an individual deposits $5,000 in cash into her checking or demand deposit account. What is the immediate effect of the cash deposit on the M1 measure of the money supply? So again, that word immediate tells us we're looking for the initial change, not the maximum change, the initial change. So it's not a multiplier question. All right, so let's now read this as a $5,000 increase in demand deposits. But remember, what this transaction began its life as cash and then it ended up as a checkable deposit. So cash in circulation goes down by 5,000, checkable deposits goes up by 5,000, but we're still operating within M1. So since the money changed from one form of M1 to another, there's no immediate effect of the cash deposit on the M1 measure of the money supply. All right, so hopefully going through that really systematically and explaining some of those elements or nuances of how to use a balance sheet will help you for any kind of balance sheet question that you face. We're going to go through and do another one. Okay, so this is from 2009 Form B, it's question 2. I'm only going to do part A because that's the only balance sheet part of the question. So, and this is asking us to treat monetary policy in a slightly different way. And what it's saying is the central bank sells $50 million in government securities on the open market. Calculate each of the following: the total change in reserves in the banking system and the maximum possible change in the money supply. And as I'm reading this, I realize I made a careless error. I applied it as an increase as opposed to a decrease. The mechanics of answering the question are the same regardless. So what you want to do is you want to treat it, look at it on, understand it this way. The maximum change in reserves in the banking system is equal to the initial change in reserves times the reserve requirement ratio. So the total change in reserves in the banking system, right, is going to be equal to the deposit when the government sells, I'm sorry, it was going to be equal to the amount of deposits coming out of the banking system in this case. So when the government sells bonds on the open market, is collecting money from depositors who are using money in their checking accounts to purchase the bonds, right? So we would have a decrease in deposits equal to $50 million. So the banks can only satisfy those depositors who are withdrawing money by drawing down their reserves. So the total change in reserves in the banking system is going to be equal to the initial change in reserves times the multiplier. So if the reserve requirement is 10%, then the multiplier equals 10. And so that initial decrease in reserves of 50 million multiplied by the multiplier means we're going to have a total change in reserves of 500 million. And then the next part of the question reads, what's the maximum possible change in the money supply? And since reserves in the banking system is the basis of the money supply, the max, since the Fed is taking $50 million out of the banking system, right? It's destroying $50 million. Then the maximum change in the money supply is going to be equal to the initial change in the money supply times the multiplier. So in this case, the answer to both is the same. And I'm going to skip over all the stuff I had on the slide because it treats it as a purchase, not a sale. So hopefully you were able to follow that. Again, the maximum change in the money supply is equal to the initial change in the money supply times the multiplier. Since the initial change in the money supply was to decrease by 50 million, the maximum change in the money supply is a decrease of 500 million. All right, and we will just skip all of this because it's wrong. Okay, so 2014 question 2, now we're getting into more of a monetary policy question conceptually rather than a balance sheet question. And so it begins asking, it tells us the Federal Reserve can influence the supply of money. And we're asked to assume that the Federal Reserve targets a lower federal funds rate. What open market operation can the Federal Reserve use to achieve the lower target? And then given our answer to that part of the question, what will happen to the price of government bonds? So we know that the Fed targeting a lower federal funds rate means increasing the money supply, making the money supply bigger. Open market operation to make the money supply bigger is to buy bonds. So the Federal Reserve can buy government bonds. You could also say the Federal Reserve can buy Treasury securities. And then as a result of the decrease in the nominal interest rate, the price of government bonds will rise. We know that inverse relationship exists. Part B asks us to draw a correctly labeled graph of the money market to show the effect of the open market operation on the nominal interest rate. So when you are directed to show, you have to start with a correctly labeled graph, price, remember to ace your graphs, axes, curves, equilibrium point. And then we know that in order to get a lower interest rate, the Fed would increase the money supply, and that's going to lead to the decrease in the nominal interest rate. Assume that the Federal Reserve buys government bonds from commercial banks. Based only on this transaction, will the level of required reserves in the commercial banks increase, decrease, or remain the same? So remember what we showed before on the Sewell Bank balance sheet. When the Fed buys right off of the bank's balance sheet, right? You don't have it's coming, you don't have to have reserves on reserves. And so the Treasury securities or the government bonds are being replaced on the bank balance sheet with reserves. And so it's really just a change in a change in total reserves. And so the net of the level of required reserves in the commercial banks will not change. Again, and they're saying based only on this transaction, which means they're not asking for the total change or the max change after those reserves start getting lent out. They're talking just this first transaction on the balance sheet. So in this case, required reserves are not going to change. And then finally, the Part D asks students to define the discount rate. And as we know, the discount rate is the interest rate that the Fed charges to member banks when they borrow money directly from the Fed through the discount window. All right, so that is the monetary policy question, connecting monetary policy to the money market. And we are going to finish up with this question about interest rates. So interest rates are important in explaining economic activity, and we're starting with a correctly labeled graph of the money market to show how an increase in the income level will affect the nominal interest rate in the short run. So we know that a correctly labeled graph of the money market has the price of short-term borrowing on the vertical axis and the quantity on the horizontal axis. We have a downward sloping money demand curve, upward sloping money supply curve, and an equilibrium nominal interest rate. And then if there's an increase in income, we know that's going to come with an increase in the desire to purchase goods and services, which is going to lead to an increase in the transactions demand for money. That's going to lead to an increase in the nominal interest rate. Part B says, use a correctly labeled graph of the loanable funds market to show how a decision by households to increase saving for retirement will affect the real market interest rate, the real interest rate in the short run. So we know that in the loanable funds market, we're looking at the real interest rate on the vertical axis, the quantity of loanable funds on the horizontal axis, upward sloping supply of loanable funds, downward sloping demand for loanable funds, and an equilibrium real interest rate to begin with. So if we have an increase in household savings, we know that's an increase in the supply of loanable funds that produces a decrease in the real interest rate. All right, and so then the last part C reads, suppose that the nominal interest rate has been 6% with no expected inflation. If inflation is now expected to be 2%, determine the value of each of the following, the new nominal interest rate and the new real interest rate. So let's bring up that equation. The real interest rate equals the nominal interest rate minus expected inflation. So initially, the nominal interest rate was 6%, we were told, and there was 0 expected inflation. So the real interest rate was 6%. Now, if inflation is expected to be 2%, what is going to happen once we increase our expectations of inflation, our nominal interest rate that we are either willing to pay or charging is going to take that new expectation of inflation into account. And so the nominal interest rate is going to increase to 8% to accommodate the change in expectations of inflation in order for that real interest rate to still be 6%. And so if we understand that conceptually, it becomes very easy to answer the question. The new nominal interest rate will increase from 6 to 8%, and the new real interest rate will remain 6%, or there will be no change in the new real interest rate. So that is the final question for tonight. So hopefully, despite my careless reading of the question, conceptually you understand how to manage and use bank balance sheets to help you understand how changes in composition of the M1 and how changes in the money supply are going to be treated on bank balance sheets in order to understand the initial changes in assets and liabilities for a bank, and then the maximum change in assets and liabilities for a bank. So go back up if you want a review of that, go back up to the slide that shows the single bank, the banking system, and those formulas for changes in the initial change in some value and maximum change in some value. So again, we went through Unit 4, which is the financial sector. There's a lot of tricky stuff in this unit. Make sure that you understand what money is, how the money supply is measured, know the difference between the monetary base, M1 and M2. Understand the relationship between nominal real interest rates in terms of expected inflation. You want to be able to use a T account and your conceptual understanding of how money is created through the lending process in order to be able to describe and predict and explain how changes on a bank balance sheet will affect the banking system as a whole. And that's important so that in order to understand how monetary policy works. So the first tool in understanding monetary policy is the money market, understanding that the money supply is a function of the monetary base, which is controlled by the Fed. Know those 3 tools of monetary policy: changing the reserve requirement ratio, changing the discount rate, and changing and conducting open market operations, understand how each of those affects the amount of reserves in the banking system, which influences the money supply. And then we finished up with the loanable funds market, exploring how changes in the behavior of households' savings and how changes in government borrowing influence the real interest rate. Those are the most two commonly assessed determinants of the real interest rate: changes in household savings and changes in government borrowing. All right, so that leads us to the end of our review for tonight. I just want to remind you, if you haven't already found it, you can log in to myap.collegeboard.org to find some optional student practice questions in AP Classroom. Regardless of whether your teacher has assigned them, those questions are available to all students so that you can practice the free response questions for your AP Macro exam. All right, so once you're in there, just click to access AP Live classes or optional practice, and then that will bring you right to those questions. Make sure you spend some time working on those balance sheet questions. I think that that will serve you well. All right, thank you again so much for watching. I hope you all have an excellent evening, and I will look forward to seeing you again next week. Take good care.